Hi guys, good morning and welcome to Trading Hour. I'm Pavitra Parekh. With me are Rima, and guess who? We have Surbhi back. Surbhi, it's so good to have you back.
Surbhi Upadhyay is back in the house, back on Trading Hour. This truly calls for a bumper start, right? It's a bumper start to the week, expiry week, penultimate one to the budget, and Surbhi's here.
It fits just like a glove, girls, because I remember the last time I was on air was on this show with you two ladies, and just so glad to be back, so glad to be back with the markets, with the economy, businesses, just to join the dots and make sense of everything. That's where the passion is.
And we can't wait to see the magic that you're going to recreate once again with CNBC-TV18. But it's great to have you, sitting with us. A quick word on the markets. It's 18,150 on the Nifty. We're currently up about 2/3 of a percentage point. This has been a very good start to the trading week. The level to watch from here on will be the 50-day moving average on the way up, which stands at 18,283. So we're still about 140 points away from that. That's the upper end of the trading band that we've been seeing. This will be a resistance level to track. It's the banking sector which is outperforming today. The Nifty Bank is up 1%, outperforming the sectoral, the benchmark indices led by strong earnings from ICICI as well as Kotak Mahindra Bank. Now, the Nifty Bank hit its all-time high levels on the 14th of December. So on 14th of December, if you see the Nifty Bank level, from that, the Nifty Bank is down 2.7%. But in that same period of nearly about, 1.5 months, ICICI Bank and Kotak Mahindra Bank have underperformed. So while the Nifty Bank is off 2.5% from its all-time high levels hit on the 14th of December, in that same period, Kotak Mahindra Bank and ICICI Bank are down close to about 5%. Now that the earnings are strong, will there be a bit of a catch-up? Axis Bank will be reporting numbers. Another important factor to watch today is that the Chinese markets are going to be shut for the full year. For the full week. Now, what have we seen up until now? That money is being taken out of India and it's going into China. Now that perhaps the Chinese markets are shut, money cannot go into the Chinese markets, are we going to see some sort of an abatement of the kind of outflows that we've seen so far? The FIs have sold nearly 20,000 crore in the cash market up until now, so that's going to be a factor that we'll be tracking very closely. Hi.
Oh, absolutely. That will be, important for us to watch. So let's see how that plays out, the entire move that we are seeing in terms of flows towards India. But, in terms of stocks, Rima was mentioning the banking pack, so I'm going to skip that and talk about some of the PSU stocks. For this month so far, you've seen the PSU index, which is up 3.5%. The other one which has done very well is IT. So today, again, you're seeing, those moves continue. So some of the top gainers are the likes of Power Grid, Coal India. These ones doing quite well. And this is something that we've been seeing all through January. In addition to those, you have some of the auto names doing very well this morning. And in fact, this week will be important for the autos because a lot of them will be posting earnings as well. So some of the larger auto names are up for you. On the downside, you're seeing Adani Enterprises there. The FPO will open on the 27th of Jan. That is on this Friday. So do watch out for that. A lot of the cement names are seeing some cuts. So Ultratech, Ambuja, I'm just naming a few, but pretty much that entire pack is in the red. And you are seeing some cuts in the new age companies. So the likes of Nykaa, Paytm, Zomato. Nykaa is down, another 3% today. And for this month alone, it's seen a cut of, around 20%. So that's what's really going on. But, overall, Surbhi, 120 points high is not too bad for our markets this Monday.
Not too bad at all, and I guess, it's probably high time, one would say, because India's been underperforming global markets, right, from the month of January. In fact, I did some number crunching just to sort of, come up to speed with things, and we'll talk about more of those data points in a minute from now. But interesting to note that the market's taking a very measured reaction to even the best of earnings. For instance, look at Reliance. I mean, that's really case in point, and, we've been discussing that since morning as well, that it's more about how much more incremental better news you can get from here on. And for me, that really stands out in a reaction to, let's say, Reliance or even in an ICICI Bank, where, yes, no doubt the numbers are fantastic. But on Reliance, obviously, concerns about higher capex, big amount of debt, when is this tariff hike coming, things like that. And on an ICICI Bank, incrementally, can you sort of keep blowing away the headlights? That's where the concern is. So more measured reaction coming through. But nonetheless, the buying is back in several names, as you mentioned. Mid-cap's sulking a little bit, and that always tells you that the market is not in sort of total blowout mode right now. It is taking things in a very steady fashion as we get up. It's also, we must remember, ladies, that The 1st of February happens to be a very big red letter day, not just because of the budget, but we'll also have the Fed announcement coming in. So whatever trading bets you're taking, you've got to keep that in mind as well. It's not just the budget factor that we can squarely sort of, react to. You'll have to keep the global setup in mind
This
as well.
time the Santa Claus rally is missing. The pre-budget rally is also missing. And considering that we have a holiday on 26th of January, there are actually only 6 working days left before the budget. So it's going to be an action-packed one because we are in the throes of the earnings season as well. On that note, it's the right time to invite our first corporate on trading, our DCM Shriram. It's in focus on the back of its Q3 numbers. The company has seen weakness in margins, largely led by the vinyl, chemicals and the sugar segment. Revenues, however, have seen a growth of 19% on a year-on-year basis. To talk about the outlook, we're joined by Amit Agarwal, the Executive Director, CFO of DCM Shriram, on the show now. Amit, morning. Thanks for joining in. This is Rima here. Could you talk about your vinyl segment? It's seen a drop in revenues, EBITDA. What has led to it, and what are the current margins and prices?
See, the vinyl business, yes, has come off its peaks, historic peaks, I would say, from about 40% margins to about 10% margins in Q3, largely led by a decline in prices, which was essentially a function of global decline in demand. However, now the margins are improving. So I think going forward, it should be better quarter.
You said the margins are improving in the vinyl segment. By how much have they already improved? And is there no visibility of getting back to those peak margins of 40%? How much better can it get from here on?
Yeah. So see, 40% was a historic, I would say, abnormal peak, right? But the average margins, if you see a long-term trend in this business, is close to about 25%. Q3 was about 10%. Currently, we are nearing about 15%. And so let's see how it pans out in coming quarters, how the global demand improves on PVC. And therefore, the margins should improve.
Okay. Sir, also talk to us about the chemical segment, because that's where the revenue is higher by about 3%, but there's obviously pressure on the operational level with the EBITDA sort of not really matching up. Tell us what the outlook is, also keeping in mind that China is finally opening up for business. What do you see that sort of doing to your business over the next, let's say, quarter or so?
See, in chemicals, it is, if I talk of India, it is more to do with the new capacities that have come in. That is point number one. Right? About 1 million ton of capacities got added in last 9 months, and some are getting added in next 3 to 6 months. Now, that is obviously increasing the supply in the country. That is point number one. Second, which is putting more pressure, I would say, is the cost, because the energy prices, we are not seeing them coming off. They've been elevated, and we do expect them to be elevated in the coming quarters as well. So that is what is putting pressure. In terms of your question on China opening up, see, it's a global market. I don't think China opening up will impact specifically on India. On global trade, it has already been impacting. It is exporting more to Europe, which is closer. So that impact is already there.
Right, got it. Amit, good morning and thanks for joining us. This is Pavitra. On the chemicals business, you've also mentioned that expansion projects are on track, but the timelines are a bit stiff. Can you, elaborate on this? Are you expecting some kind of delay over here?
So we are targeting to complete all our expansions by Q1 of next financial year. But what I mean by stiff the timelines is that given that there are supply chain disruptions, given what we have seen in China, where there was COVID-related lockdowns, and therefore it has impacted the supply chain across the globe. And we have capital equipment coming from overseas. So we do see some slippage, maybe of 1 to 2 months, but we're trying to pull it back.
Okay, so Q1, Q2, FY24 is when your expansion in the chemicals business should get completed. So this is going to be one avenue of growth, right, for you, the expansion in the chemicals business. You also have cash on the books of close to about 100 crores, and you are actively looking for more avenues for growth. Could you elaborate? Is it inorganic? Are there acquisitions that you're talking about?
So one, the cash on the books is close to about 1,500 crores. Right, and we have a debt of close to about 1,400 crores. So therefore, the net, what we mentioned in our numbers was that we have net surplus, net debt of a positive 100 crores of cash that we are having. Now, see, we will be completing our capital expenditure programs of 3,500 crores in next 6 to 8 months. part of it is already completed, where we've largely implemented the sugar expansion plans. And chemicals will get completed, and even Fenesta will get completed in next 6 to 8 months. Now that will definitely lead to a lot of growth in terms of volumes and new revenue streams. Now, see, we are generating cash close to about 1,200 to 1,500 crores every year, which puts us in a very sweet spot to continue to invest in growth, and which we'll continue to do more aggressively. And that's what our plan is, and we will do that in a more sustainable way.
Ruling out any acquisition?
Pardon me?
You're ruling out any acquisition, Amit?
So see, we are open to both organic and inorganic. So there is, it's not that we are not looking at inorganic route. We are open to both.
Amit, you're also saying that you're expecting a lot of growth to come through, once all of these developments do go through in the next couple of quarters. So can you tell us then for FY24 what the revenue could look like, taking, all of this into consideration?
See, revenue will definitely see good growth in FY24, and I would say more in FY25 when we will have a full year impact. Because these projects, once they come in, they take time to ramp up. And there are a lot of new products that we're launching, and therefore they'll take time. So FY25 should be a good revenue year, as well as the profit year.
FY25 will be a good revenue year as all the expansion plans that you've put in place will come to a fruition. Thank you very much, Amit, for joining in. That's the word coming in from DCM Shriram. Get into a break. Up next, we'll discuss what's buzzing in the commodity space. Manisha Gupta joins in next.
Welcome back here with us on Trading Hour, and it is time to talk commodities. Manisha is here with us as always. Manisha, great to be chatting with you on air as well today. What do you have for us?
Good to have you back, Survi. It's good to be talking on air and off air, both in the office.
Absolutely. Thank you so much.
But gas prices is what I'm looking at. And, the last 4 weeks have seen constant decline in case of gas prices. And that is because the northern hemisphere temperature this time around has been above normal. This has been the warmest winter that northern hemisphere and US, etc. have seen in last 2 decades. Now that seems to be changing. And even as we are heading into the last week of January here, the expectations are that the next fortnight could see below normal temperatures in the northern hemisphere, and the demand actually could go up, and so could be the heating oil and the natural gas prices. So there is some support coming in because of that. We did see prices decline to $3.11 per gallon, but now we're looking at 3.4 coming back on screens right now. So 5% of a jump up is what we've seen this week begin with. We did see 5% of decline in the previous week. In last 4 weeks, we have seen the gas prices decline by 48%, but there is some support coming in now. The markets also believe that the withdrawal that we have seen in the month of January has been much lower than last year and much lower than the 5-year average as well. And as far as the US production goes, well, that continuously has been increasing. For 2023 as well, the expectation is that the US production could increase by 2% to 100.3 billion cubic feet on a daily basis, and that will continue to put pressure on prices. The highs that we saw in previous year at almost $10 is something of a past, markets believe. And while we may have peaked out, the markets also believe that we may have bottomed out as well. And anywhere between $3.5 to $5 is where the natural gas prices could now range between in the next couple of months.
All right, Manisha, thanks a lot for getting us that quick update on the natural gas prices as well as the move. But with that, we're going to get into a short break now. It was a good quarter for Union Bank of India. So we're going to take a short break. But on the other side, we have a very interesting chat lined up. Hey guys, welcome back. You're still tuned into Trading Hour. The market is still up with a 110-point gain that we are seeing. The bank's also holding up quite well. It is almost 400 points higher on the Nifty bank, but the mid-cap index is where you're seeing a little bit of softness today. So just around 0.25% in the green for the mid-cap index. But let's talk about some individual companies now. Union Bank of India reported a strong set of Q3 numbers with the best net interest margin and ROA that we've seen in 8 years. The asset quality also looked good. It came in at the best in 7 years. Abhishek Kothari earlier caught up with Ramasubramanian S., who's the executive director of the bank, and began by asking him about the robust loan growth that the bank has seen and whether they can really sustain it going forward. So let's listen into that chat.
There is always there's a good demand for the credit in the banking sector, and not only our growth. Growth is on all sectors, including RAM and also in corporate sector. Corporate sector, we have shown a growth of around 20%, and the RAM sector also not fall behind. It is around 17.76% as shown the growth. So we expect that with the presently, if you're looking at even at our credit growth, it is around 20%, and with our deposit growth is around 13%. We expect that there will be a little tightening of the rates, and we expect to reach around 12 to 13%, which is above our guidance rate.
One of the good part, as you mentioned, is that there has been loan growth across segments, especially the corporate portfolio. Now, in that corporate loan growth, are you seeing capex-based demand coming back, or are you still seeing working capital loans that corporates are taking? And if they are taking working capital loan, by when do you expect, the capex-based corporate loan growth to come back to the banking sector?
Yeah. Actually, if you're looking at our growth and even whatever the availment, what we are having it is on both. We are having a project loans also as there, and there is a good availment in working capital limits also. If you are looking whatever the new projects, this is major. It is happening in infrastructure, where we have a good pipeline of HAM project and the road sector, and we are also very bullish with chemicals, steel, cement industries, where we find that there are a lot of availment in the working capital also. And going forward, we expect that not only these sectors are going to contribute, we also expect that there will be more contribution from pharmaceuticals and also from other ancillary units.
Well, net interest margin was at 8-year high for your bank, coming in at 3.21%. We know that, till now there has been the rate interest, which has actually helped in net interest margin on the yield side. So going ahead, as you mentioned that the loan growth will slow down, how do you see the net interest margin panning out?
Yeah, I'm not saying that loan growth will slow down, but there will be there will not be such a high growth you are expecting in the coming day. But anyway, we expect that there will be a continuation of growth in the credit offtake in the coming days also. But if you are looking at a NIM, literally speaking, there was it has contributed our latest rate hikes have contributed to the our NIM increase. And if you are looking at our advances or credits have been carrying this hike more or less for the entire quarter, whereas deposits rates have gone under last second half of the quarter. So because of that, there is a little bit higher NIM is there. But going forward, we will be also looking at even in a loan portfolio, we will be looking at good NIM margin, and also we will be going and we will be trying to protect the NIM what presently we are having it. And anyway, we will be again guidance has been given for 3% for our NIM that will be reached.
In Q3, one of the best point in your result was the slippage ratio. The annualized slippage ratio was at 8-quarter low. So could you guide with respect to your asset quality or gross NPA ratio for FY23 and FY24?
If you look at it, presently, we also have a very good system, and with our entire branches are looking at containing the slippages, we are able to show a better results. And if you look at it, there is not much bigger SMA accounts in the corporate sector. So the slippages have to be controlled in retail and MSME. That is being done by the entire team at Union Bank of India, and we continue to do so. We will be trying to always, our guidance is our slippages will be less than the recovery and upgradation in each quarter-on-quarter basis.
Welcome back. The next corporate conversation that we have going is from L&T Infotech. LTI Mindtree. Now, this is the first time the company is reporting numbers post their mergers. And Q3 numbers were a miss. It was a miss on revenues, a miss on margins. Margins, in fact, have contracted very sharply, about 350 to 500 basis points if you look at it quarter on quarter or on a year-on-year basis. That said, the company has given a 4 to 5 year vision where they are talking that this merger will result in $1 billion of revenue synergies and will also help improve the company's margins by 200 basis points. That perhaps has taken some of the sting out of the Q3 numbers because the stock has recovered from the lows. I had a chat with Debashish Chatterjee, the MD and CEO of LTI Mindtree. I began by asking him about the Q3 top-line miss. What was the impact of furloughs, the lesser working days on the company's performance? Listen in.
We had an impact of 130 basis points because of furloughs and lesser number of working days. And we anticipate that bulk of that will be nullified as we move into Q4. And apart from there was also 100 basis points impact due to the integration cost that we had to take. And bulk of the integration cost we have already taken in Q3. There'll be a little spillover in Q4 as well. And having said all these things, we are very confident that as we get into the Q4, for our Q4, we will have 200 to 250 basis points improvement in terms of our EBIT margin. And as we get into FY24, we should be able to, for the full FY24, we'll be again operating at our erstwhile margins that we used to talk about in terms of our profitable growth story.
So FY24 margin should be 17.5%?
It is, we don't give a guidance, but, if you do the maths, you can figure out. But yes, definitely we will get back to what it used to be as a merged entity before Q3.
Okay. The impact that you indicated on account of furloughs, integration was on the margins. Could you tell us the impact on the top line?
No, as far as the top line is concerned, we did have, if you have furloughs, then you do have an impact on the top line as well. But overall, our accounts grew fairly well. We had a good sequential growth. And, if you look at the YOY growth, it is around 14% and 16.3% in constant currency, which is very encouraging and which is still in the top quartile for all the within all the IT players. So we are very confident that we'll continue with that growth as we go along.
So what could Q4 revenue growth look like for you?
Well, I think the momentum that we have in terms of our pipeline and the deals that we have closed in Q3, if those things continue, I think the Q4 growth will be definitely in line or better than what we had in Q3.
Okay, so Q4 growth better than Q3, which was 1.9% in CC. You spoke about deferrals in some projects. Which segment, how many projects got deferred?
Well, I think, it's difficult to call out how many projects and all those things, but let me tell you that some of this deferral is not something which is just, either a sector specific or, a set of client specific. Across the board, we have seen there are some projects which got deferred and some projects where the decision making has been slow. But the good news is that across the entire portfolio of our clients, we have not seen any cancellation. In fact, what we are seeing right now is there are a lot of opportunities, which is all about cost takeout. How do you bring more efficiency in the system? And the reason why clients are jumping on those initiatives is they want to continue to fund their in-flight transformation programs. And by taking some cost out of the system, they should be able to fund those transformations, which we are already participating in. So it means that there are more opportunities for us in terms of some of these cost takeout deals, which also tend to become more longer-term annuity opportunities.
But many companies we spoke to, Persistent, HCL Tech, they all indicated that furloughs are likely to extend into Q4. The impact is not going to be as much as what we saw in Q3, but it's not going to be negligible as well.
That's exactly what I said, that some of the furloughs may extend, but we don't anticipate. I mean, there are multiple factors. You can't just focus on only furlough, but that's why I said that including all the factors, we have done our maths. We feel that 200 to 200 basis points improvement in margin from where we ended in Q3 is definitely a possibility, and we are very confident about that.
Can you talk about this 4 to 5 year plan that you've outlined of $1 billion of revenue synergies and margin improvement of 200 to 300 basis points? What is driving this guidance? What have you baked into? What are the assumptions that you've made?
Well, we are right now going through the strategy exercise. We have, rolling out the plans in terms of what we see the organization in the next 3, 4, 5 years. And we probably you have to wait a little longer before we share all those details in the coming quarters. But one thing is very clear, that the entire parlance of this merger was to generate more synergies in the marketplace. And given the capabilities that we have as an integrated organization, we are very confident that our upsell and cross-sell opportunities are going to help us in terms of creating more synergies. And that's what we talk about. That's what we feel as we are very confident over the next 4 to 5 years, we should be able to create $1 billion in revenues in terms of synergy. And we also have been saying that the synergies in terms of revenues will be front-ended, because that's what is going to be our focus at the initial phase when the organization comes together, which is now. And as we go along, given the larger scale, there'll be a lot of opportunities of synergies in terms of efficiency as well. But that will be slightly back-ended. So we are going to focus on that over the next, next years. And again, we are very confident that 200 basis points of EBIT improvement is possible over the next 4 to 5 years.
The EBIT margin improvement and synergies is 200 or 200 to 300?
Around 200 basis points.
200 basis points.
Yeah.
Okay. Got that point. Since this is the first quarter, we don't have much by way of a track record, but 1.25 in terms of $1.25 billion in terms of deal wins, is that the quarterly run rate we should expect from the company now?
Well, I think the deal wins should never be looked at a particular quarter. You should actually look at it over a particular year. And as you rightly said, this is the time when we are creating the baseline. So we have to see how it goes. But definitely, given the pipeline that we have, we expect to, we are also working on quite a few large deals as we speak in various industries. And we should be able to report the deal wins as well as the order book as we go along. But I would request you to look at it over a 1 year period to just form some benchmarks.
Do you think this could be the new base for deal wins, $1.25 billion?
I mean, we are very confident with this base, what we have done so far. It gives us a lot of confidence in terms of growth in the business in the coming quarters.
All right, that is the management of LTI Mindtree. They're saying that deals in the pipeline suggest that growth will actually be better in the coming quarter as compared to Q3 as well. But with that, we're going to get into a short break now. But a quick programming note as we do that. And here's an update for our viewers. CNBC-TV18 has compiled a list of top 20 stocks that you should watch for this year. It is a carefully curated list of companies that warrants a closer look in 2023 based on factors like growth prospects, new launches, management changes, reforms, and lots more. As a disclaimer, this definitely is not a recommendation list, but a list of companies which have meaningful triggers lined up this year. So tune in to CNBC-TV18 tomorrow at 10 a.m. when we will give you a sneak peek into the names and reveal the list. Hey guys, welcome back. You're still tuned into Trading Hour on CNBC-TV18. And just a while ago, we were talking about how this year so far, that's in January so far, we have seen India underperforming a lot of the global markets. So Surbhi is standing by at the big wall to tell us about some interesting data on how overall global risk appetite is looking and what it really could mean for India in this context. So Surbhi, it's over to you.
Well, thank you so much for that. Yes, I've been looking at some numbers to see if this elusive pre-budget rally will start or not. Now, there's one thing that January 2023 seems to be confirming. It is that global risk appetite is well and truly back, no matter all the talk of recession, central banks, inflation, and so much more. Now, here is some interesting evidence that's supporting that. 4 very simple and clear points. I'll start first with what global markets are doing. And global markets have been surging. Almost all key indices, whether you're looking at the Americas or Europe or even Asia, markets have been going higher. I mean, look at this. We've got a 4% surge on the S&P already in recovery mode. And some of the markets in Europe have done really well. Some of the Asian markets with China's reopening also doing very well. Now, it is not just equities. The crypto market has stirred back into action in 2023. And how? Look at these numbers. 39% on Bitcoin in January. I just wanted to put that figure up there in case you missed it. You're talking 35 to 36% on Ethereum as well. So when the crypto market is stirring, you know that risk appetite is back. Now, this is not enough. Let's get to tech. There is buying returning to big tech after the 2022 chaos. The Nasdaq, as the previous graphic illustrated, is up over 7% in January. In comparison, the Dow is up less than 1%. What does that tell you? Even in the mother market, where's the money going? It's going to technology. People are looking to snap up bargains. Now, consider the market's reaction to apparent bad tech news. Investors are choosing to buy into stocks rather than sell any further. Take Alphabet and Netflix as examples. Now, Alphabet was up 5%, a little over 5%, on the day that Google actually announced 12,000 layoffs, citing a challenging economic environment. So investors are choosing to read it very differently. In fact, investors lapped up Netflix shares, choosing to focus on the beat in monthly subscriber additions. That was a big beat number, by the way, over 7.5 million over there, instead of the big EPS miss. So it's just the way people are analyzing numbers now. If you need any more evidence that risk appetite is back around the world, let's take a look at the mother of all fear gauges, and that's the US dollar, which is what investors typically rush to in times of uncertainty. Now, after a massive 6-month surge, the dollar rally has certainly paused. In fact, in January, it's down. The dollar index is down about 1.5%. Okay, so we're convinced that the global risk appetite is back. But what does this mean for India? Well, not much, at least up until now, unfortunately. And that's perhaps due to the fact that we had a superior performance in 2022. We were one of the best performing markets in the world. And the fact that China has reopened, prompting a shift of money to that market. We all know these stats. We are underperformers here, not by a huge distance, but the fact is we're in the red for the month of January, underperforming most key global indices. Also, something to note, foreign investors have gone back into selling mode after the buying that we saw in November and December. This month, we are down by about 15,000 odd crores. This is not to say that domestic institutional investors don't make up for it. We know the retail buying that can completely set aside the foreign selling. That's what 2022 was all about. Very quickly, let's now take a look at what January typically does. I mean, history doesn't always repeat, but it rhymes, they say. So I looked at the last 5 years. It's only in January of 2018 that we actually had a great Jan rally, almost 5% higher. The rest of the 4 years, we're flat to mildly negative. So will 2023 be any different? We only have a couple of days to the budget to see if the track record moves back to the green side.
All right, Surbhi, thanks a lot for getting us that very interesting data. It will be interesting, to see how the rest of the 6 trading sessions pan out. Like you were pointing out, we just have 6 sessions until the budget. So, it will be interesting to see how that looks for us. But with that, we're going to get into a short break on the show. When we come back, there's lots more market action and talk lined up for you. We will also be speaking with Abhisar Jain, Head and Fund Manager at Monarch, on the other side.
Welcome back. Here with us in Trading Hour, still managing some green on the screen, just about 0.5% up on the benchmark indices. Let's take the market conversation forward. Abhisar Jain, Head and Fund Manager of Monarch, is with us now to talk about the way forward. Abhisar, good to have you on the show. Thanks for joining in. So I'm just going to go back to all the data points that we were just discussing and this underperformance of India in 2023. Do you expect it to continue because we've had a great run last year, or do you think it's time for a pre-budget rally?
Yeah, so thanks a lot for having me on the show. I think we are quite constructive on the Indian market, mainly because of 2 key reasons. One is that going into this cycle, as my peers have also been saying, the balance sheets are in the the best shape possible for both the corporate India as well as for the banking sector. And that would help us going ahead as we move into the new credit cycle, as we move into the investment phase with all the PLI and the focus of the government on increasing the manufacturing. Second thing is that the market have spent quite a bit of time in this range. So if you were to see in 15 months back, we were at this range, what we are today. And we have spent this time, we have had an odd big dip in between, and we are still here. So that has made the valuation a little bit more reasonable. The premium is still there for the market versus its 10-15-year average, but it is much more reasonable. So we are constructive. And for this year, hopefully it should be an okay market which tracks its earnings.
Abhisar, morning. Rima here. I want to talk about that bold call that you made on super quality growth stocks in January of last year. where you believe that 54 growth stocks, which are high quality, but they are trading at astronomical valuations. Well, since then, in the last 12 months, we've seen the derating in many of these stocks. What is the call now? Which of these 54 stocks that you've identified, and where can we still expect to see some derating, and which ones have hit trough valuations or normalized valuations according to you?
Yeah, sure. So Rima, see, as portfolio managers, what we were kind of witnessing going into towards the end of 2021 was that for years no end, almost like 5-6 years, there was this lot of set of high quality stocks which were going up in share price more than what their earnings were doing. And this was consistently pushing the valuations for these stocks higher and higher. And that's when, at the end of 2021, we decided to call it out. We kind of put a name to our note as the scary side of super quality stocks hiding in plain sight. Because believe it or not, this 55 stocks as a basket were trading at a PE of 85 times and the EV EBITDA or EV cash flow of more like 50 times. So notwithstanding the underperformance of 16% that these kind of stocks have had in 2022, still the absolute valuations are very, very high. And the earnings growth, more importantly, is the same as they have delivered in last 5 years, 10 years. Okay. Also, astonishingly, Rima, the premium for these own stocks with their own average of FY12 to 17 is still more than 100%. And the premium is still more like 40-50% to their 10-year average. So these include all the quality names, all the quality names from all sectors, consumer, industrial, IT, and these stocks we believe that will have some more valuation adjustment to go. Of course, some of them who surprise on the earnings positively can still do well, but we believe that the valuation adjustment has legs to go.
Please, could you name some of these stocks where valuation derating may continue to take place?
So Rima, we have mentioned that in our note in the annexure, this is a big list. As I said, the list has some of the loved large caps. At some point of time, these were considered at buy at any price stocks. So the largest paint company features there, the largest consumer FMCG stock features there, some of the large IT companies features there, some of the industrial stock features there. And it's not about one stock as such, it is about a basket as a whole. And just to repeat myself that, there will be some companies which will deliver that very solid earnings growth and can still do okay. But a majority of them are not in sync with their earnings, and their quality was always there. It was always a well-established quality, but it's just that in the last 4 to 5 years, the multiples kept on increasing, and now adjustment might be happening towards the other side.
We try and push our luck. We don't have that annexure with us right now in the studio. Would you mind telling us maybe just 1 or 2 names where you really think that this whole derating has, more time ahead?
Yeah, so Surbhi, see, from the peak, this whole basket has fallen 30%, maybe Nifty has fallen only 5%. So the stocks that you were just showing on your screen, the HUS, the Asian Paints, the other consumer names, the lot of IT names. IT names have, of course, seen a much more massive fall, and hence with kind of earnings which have been quite good, they may find finally a base. But there are a lot of others, in that list, which in our view will still underperform. So our call is on the basket. It's not on one individual name. And what we are saying is that the valuation adjustment, which has just started in 2022, may continue into the following years.
So how much of a further underperformance are you expecting in, say, in 2023 for the overall basket? I'm not going to ask you about individual names, but yeah, if you could tell us about the the full basket.
Yeah, sure. So see, Pavitra, the basket has underperformed in 2022 by around 16% odd. Okay. So I don't know what exactly will underperform in this year, but of course, I do believe that the absolute valuation for the basket, which is still a 55 to 60 on PE, which is still a 35 to 40 on EV EBITDA, and which is more than 50 times on cash flow, leaves a lot of room to underperform, because as I said, this whole basket on its own valuation in FY12 to 17 period, when also they were quality, when also they were having these kind of earnings growth, is still at a more than 100% premium. So I'll not be surprised if the underperformance is to the same magnitude, some double-digit magnitude, maybe 15%, maybe a little bit more. But it should be in this calendar year also something around that, because we know that the liquidity is tight, the interest rates have gone up, and that also has it works against the valuation multiples, right?
Abhi's are out of time. Thank you very much for joining in. And those stocks that he was referring to include HUL, Asian Paints, Avenue Supermarts, Pidilite Industries, Divi's Laboratory, Godrej Consumer Products, Britannia, Havells, LTI Mindtree, Berger, Eicher Motors. The list is very long.
You know, we should actually have him back once perhaps the earnings season is over, because that could be an immediate trigger as well, right?
Absolutely.
Like
I also wanted to ask him what his take is on the hallowed consumer technology stocks, but that's a conversation for another time.
All right, for now, it's out of time on Trading Hour. Thank you very much for watching. Halftime Report is up next.